Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is January 3rd of the new year, 2024. As I look back on 2023 and think of the year, it was really an interesting year. It started out on the heels of 2022, the ending of 2022, which was by and large, a pretty negative year. A lot of portfolios, probably every portfolio I know of, was negative for the year, and some of them were quite a bit negative. And so then 2023 begins. People had a very negative mindset that the market probably has some more downside. And then the Fed was raising interest rates, and we're probably going to have a hard landing, meaning the economy is going to struggle. Well, those things didn't happen. So what happened was the Fed did continue to raise rates, but it had minimal impact, not serious impact on the economy. The market shrugged it off a lot, and it had some down period, a down period probably in August, September, October were negative mostly, but nothing serious. And then it rallied from in November and December quite a bit into the end of the year. So really it defied a lot of, almost all of the conventional thinking that was present in January of 2023. So as we look forward into 2024, I listen to a lot of people. I don't listen to anyone in particular, and I don't manage money based on what people say. If I think this, I think that. That does not affect at all how I manage money. So, but listening to the consensus view is that it's probably going to be a positive year, but I am also hearing it won't be a straight line. The market will not go from January 1 to December 31 in a straight line. It will have its own ups and downs probably. So I'll make a comment here that of how we do manage money, and the reason we had a good year. We were I'll give you some detail. I don't tend to talk about our management or portfolios very much, but I will mention it here because we're at the end of the year and it's on the top of my mind right now. We have many strategies, approaches that we use, but our most core strategy is invested in the market, no leverage, no shorting, in what we call our moderate momentum strategy. That strategy, and we're in the market historically over a period of about 5 years. We've been in the market about 70% of the time, and we've been out of the market in money market funds about 30% of the time. In the year of 2023, our performance was 23% positive, and the market was 24% positive. So we were very market-like in our rate of return, but we took less risk than the market. So over a long period of time, we take quite a bit less risk than the market. And so we were very pleased with that. Our high performance was up 44%, but that uses leverage. And and our crypto strategy for 8 months, it's only 8 months old, was up 19%. So we're pleased with this. Our results are published. We put them on our website. So by Friday, January 5th, they should be on our website under the performance tab. And then we also put them on Theta Research, which is an independent data service, and they publish it. They only publish live data. They do not live performance. They do not take theoretical or back tested or anything. It's got to be live. And so those are the places that we publish it, and we're glad to do that. I would say most managers do not publish their results, and I'll let you maybe figure out why for yourself. So looking forward into 2024, we are invested at this point. And we will get out of the market when our methodology, our mathematical methodology, tells us to get out of the market. But and I expect that'll happen some in 2024. The two things I think that are positive, or the two or three things that are positive, that are probably going to propel the market upward are these. One, that the Federal Reserve is dropping interest rates. Interest rates seem to be on the decline. Inflation seems to be on the decline. Thirdly, it's a presidential election year. And usually the party in power somehow, regardless of which party, they both do this, somehow see to it that the economy is goosed enough, technical term, goosed enough to propel it upwards. So that, and also there's a lot of ad spending around the presidential cycle, and that tends to propel things upward. And then the Olympics are this year. So again, more ad spending. So a lot of things going on from a macro perspective that I can see influencing the market continuing to influence it in an upward direction. So I'm not trying to make that as a prediction. I'm just giving it as an insight. And since I do not manage money that way, there are people that do. You can take that and do what you want with it. But I think it gives you a perspective, a mindset on how at least I'm approaching it from just my view of the market. So, okay, so let's get into, I want to get into the dashboards, and this will give you a view of both the last week and the year to date, the entire 2023 on the indexes and the sectors. So we'll start with the indexes. So look at this. If you followed me, you know that you've seen this. You've seen the far right of this, excuse me, be all red. You've seen it be mostly red. And you've seen it be mostly green. And now you're seeing all green, including Treasury bonds at the very end. So this is a very unusual view. It won't last long, probably. So let's look at the kind of the second column or third column, the view for this past week. The view for this past week, most of the indexes were positive. You can see that they're in green. Treasuries were almost flat, slightly negative, but the emerging markets definitely did the best, up 1.62%. Year to date, NASDAQ 100 up 53%, S&P 500 up 24%. The Russell 2000 small cap index was very low and has surged up now to a 15% return for the year. And the Dow Jones up 13 and emerging markets up 6. As you look to the right, you can see all the green dots. Those are the moving averages. How is that index relative to its moving average? Is it above the moving average or below? This is a very bullish sign that all of them, even treasuries, are above their 20-period moving average. Hard to have this and have a down market in front of it. It could happen. I'm not saying it couldn't. It's just there is momentum in the market. Buyers are coming into the market. It's been bullish for the last 2 months, back to the beginning of November. And it does seem to have momentum associated with it. When we look at the sectors, the component parts of the S&P 500, you can see the last week, the one that was negative was consumer discretionary and energy. Everything else was positive. Even if it's slightly positive, they were positive. And then the year to date is in the pink box, and that is technology, consumer discretionary, way up at the top, 54, 38%. You drop down to retail, 19, industrials, 16, basic materials, 10, and so forth. It goes on down. And then there are a couple of sectors, the consumer staples and energy at the bottom were both negative. And by the way, last year, consumer discretionary and energy, consumer staples and energy were at the top. So everything this year, and the ones at the top were at the bottom last year. So everything just almost inverted and went the other way. By the way, the last three on here, not only consumer staples and energy, but healthcare, those three were at the top last year. So that's just how the market can, change directions. It happened to occur in one calendar year and another calendar year. Usually it's not quite that precise. And there are 4 out of the 44 possibilities of green dots, 4 of them were negative. 40 were positive, and that was the same as last week. Okay, let's take a look at this is the S&P 500, the ETF SPY, which tracks the S&P 500, measured over a period of 18 weeks. So you can see the direction, and I showed this with a black arrow, the degree to which the S&P 500 is on an upward incline. And so, as I said at the beginning, the market seems to have momentum. That doesn't mean it will go straight up. It never has. It will go up. It may go in an upward direction, but it will have, like this year, it will have some up and down periods. We'll find out this year what kind of up and down periods are in store for us. But I do believe we've got money coming into the market and market momentum, and that's what this chart says. Next, when you split the S&P 500 into its 2 major parts, growth stocks and value stocks. The growth stocks are the numerator, and the value stocks are the denominator, measured by SPY-G and SPY-V in an equation. That allows us to see the relationship of growth to value. So because SPY-G is the numerator, when it goes up, this line goes up, it favors growth. When it goes down, it favors value. And I put a black arrow at the end of it so you could see the degree to which it is favoring value. Yes, from the beginning of the year up until October, it favored growth mostly. And now you can see the direction is favoring value stocks, those stocks that are more focused on profits than on sales. It could be financials, it could be healthcare, manufacturing, agriculture, things like that. So not Google, Microsoft, Amazon. So they could both be going up, but what this tells you is value is going up at a greater rate than growth. Small cap in the last couple of months has been surging, and that's good because that's another good sign for the market. As a result, this relative strength chart putting large cap S&P 500 SPY as a numerator and IWM Russell 2000 Small Cap Index ETF as denominator, it's been going mostly up until the last couple of months, and then small cap came into favor. Look at the degree to which small cap outperformed the large cap, and large cap did well for this time period. So small cap just surged, and that is represented by the direction of that black arrow. Long-term government bonds. There's a kind of a tale of two markets here. The long-term or intermediate term direction for the last 42 months is that long-term bonds, government bonds, are down. They especially went down all the way up until October of this year, even continuing from last year, and hit a new low. But then the last couple of months have surged upwards. So I showed that with a red arrow, that surge, but you also can see the long-term direction over the last 42 months for long-term government bonds. The dollar continues to weaken relative to other currencies. So some other currencies are stronger than the dollar. And this has happened again over the last 2 or 3 month period of time, represented by the black arrow. Gold continues to surge. It's doing the best between gold and silver. And this is a chart showing that the black arrow shows the direction of gold, and then the weekly moves are represented by the line next to the black arrow. So yeah, almost coming up to, I don't know, a very high period. So silver has not, is same direction, generally going up, but it has not surged as much as gold has. And you know, most people know that that's a manipulated market, and for various reasons that I don't completely understand, but gold during this period is outperforming silver. I put this on a chart because it helps explain the difference between the two, or show the strength difference. So on a relative strength basis, silver is a numerator, gold is a denominator. What this says that if it goes up, it favors silver. If it goes down, it favors gold. So you can see over the past, what is this, year or so, about the last year, that the general direction on a relative strength basis is that gold has been outperforming silver. There are periods like before that where silver was outperforming gold. Bitcoin this year has had a very good run. That is represented by the equity line, and it's also represented by the black arrow. So you can see it's had a little bit of a pullback lately, but it's expected. People who follow it are expecting that they believe it will go up into 2024. But certainly 2023 was a very positive year for Bitcoin and Bitcoin-related stocks or other types of crypto. Volatility index. Now, when stocks go up, equities in general, indexes or stocks go up, the volatility index goes down. In other words, there's less volatility in the market when stocks are rising. So you can see, I just drew an arrow from October of 2022 to present. So this gives us a view of about 15 months. I showed that with, I'll call it an intermediate term view. The black arrow, the volatility is coming down. Then I showed the last couple of months with a red arrow that during that shorter term period, volatility is declining at an even faster rate. So this is good for equities, good for investing, at least for now. So it's the number on the volatility index is 1245. That's a very low number. I don't know the absolute all-time, but I think the absolute all-time was in the range of 10. But getting down below 20, down below 15, these are very good numbers. Asbury 6. Asbury Research has 6 metrics. They call it the Asbury 6. And currently there's 1 of those that is negative and 5 of those that are positive. Again, this is an overall positive sign for the market. Relative performance, cross-asset relative performance. And what this is doing is comparing one asset to another. And I will look at the ones that are in all categories in those 3 large columns on the right, the last week, the last month, the last quarter. And those include blue chips, which is the Dow, which tends to be value stocks, is stronger than, in all 3 time periods, stronger than the S&P 500, the broad market. The developed markets, mostly Europe and Japan, are stronger than the U.S. So when U.S. is compared to developed markets, the developed market have won in all 3 time periods. And corporate bonds are stronger than high yield bonds, junk bonds. So the U.S. versus the world. Those that are stronger than the U.S. in all 3 categories, time periods, are Chile, Canada, Switzerland, South Korea, India, and New Zealand. That's it. The U.S. is stronger than other markets, the following other markets: Spain, the United Kingdom, China, and that's it. Those are the ones that the U.S. is stronger than for each of those time periods. Gold and silver. So gold was up again for this last week. It's been in an upward trajectory. It was up 0.5%, and it is up to 20.56. That's the spot price. On top of that, you need to add the markup. So silver is down 1.5%, down to 24.21. Usually they move together. This time it was a split week. The gold-silver ratio remains at 85:1. When you look at the monster box, this is 500 rounds, 1 ounce per round of silver put into tubes. That monster box of 500 sells for $13,100 as of Friday. And it includes, the markup has come down a little bit, so the markup is $1.99 over spot, and the price per round in that 500 quantity is $26.20. And for, if you buy it in just a tube, one tube of 20, it's $26.70. So a 50 cent higher per round when bought in that smaller quantity. And this is what my son Preston sells it for. I give it to you in this format so that you, if you want to shop local or wherever you shop to get it, or buying it or selling it, at least you can see what the kind of the going price is for both the, per round and the tube and the monster box. So hopefully that's helpful for you. And I've said to you, I definitely prefer brick and mortar. I do not like buying things over the internet, particularly like this. I do know people who have lost money in buying precious metals over the internet, and I just don't know. I can't, it's hard to evaluate something when you can't walk in the door. And then I also like, buying brick and mortar. Local, brick and mortar, that's it. So at least that's it for me. So I hope you had a healthy and productive 2023. I hope it was a good investing year for you. It was a year of opportunity. And it looks like maybe 2024 will be a year of opportunity. I hope so. And I hope you do well. If you have questions or comments, feel free to give me a call, or you can leave a comment in the comment section at the end of the video.